This is a video on Google as part of the weekly feature stocks series brought to you by PolarisInvesting.com. The date of this video is shown under the name of the company, the ticker. And as a reminder, this video is feature stock video is intended to be anywhere from 5 to 10 minutes. You'll notice that the title of the video has the word either suspect or prospect after it to reflect the outcome of this brief assessment that we're doing here. As a reminder, prospect means that conclusion was that there's enough belief on a cursory look at the company that it should be considered by the investor as a candidate for them to consider going forward and make their own decision eventually as to whether to buy the company or not. If it's suspect, it means that some doubt has been raised during this brief assessment and it's not recommended to even be considered as a candidate. If you have any questions about any material that's discussed during this assessment, I invite you to go out to the PolarisInvesting.com YouTube channel, and two playlists in particular out there. One is on concepts and the other one is on the valuation calculation itself. So I invite you to go out there and watch those. We'll get started here. Look at using the default value, Polaris default values, what kind of practical investment return we can expect, and coming up with 3.9%, which is pretty low, and on the surface makes this appear not to be a very attractive stock right now based on current market conditions. But we want to look a little bit further. One is that, notice here the operation type is being shown as being dynamic. Having looked a little bit more into that, it's being flagged as dynamic primarily because of the outstanding stock options and the potential dilution that may occur if all those stock options were exercised. Price momentum, you can see here that the stock has gone down relative to the overall market recently. And when we look at more price information, you see here over the last year that the market has gone up, that it's about even with the market. Both are up about 11% over the last year. But here recently, in the last 3 months, we've seen a movement where the downward trend of Google has been more than that of the overall market. If I change it to 3 months, you can see here that the Google is down 14% and the market's down about 4%. Scroll to the bottom, look at the industry that Google's in. This is a relatively new industry that's been created to include companies like Google, called online services in the technology sector. This is a fairly fast-moving, dynamic type industry. So to go along with the operations type, I think it's consistent that we think of it being in a dynamic environment, and that which means that it could see a lot of changes in the short term around Google and the industry that it's in. Well, let's look at the input parameters that were used by default by Polaris. First off, is the primary input value is the sales growth that's being assumed, and the default value that Polaris is using is 26%, which that seems pretty high for an average company in the S&P 500, but for this industry, that isn't all that high. When we go down here and compare it to what CNN is showing, we see here that on the CNN site, the analysts that were polled here are showing an annual consensus growth of 50%. And then scrolling up here real quick, we see the one-year price targets of these 40 analysts that range all the way from $1,658 down to almost even $1,000. So as to be expected for this kind of company, quite a range of values. So now coming back up to the sales growth slider, question is, Do we use the Polaris' default of 26? Do we be a little more aggressive and go towards more like 50%? Let's come back and revisit that. Let's go look at the other input parameters that are used by the Polaris. One is the share issue trend, pretty mundane value. It's in line with a little more stable. Like we said, the operations of Google are considered dynamic, but that's primarily because of the outstanding shares. But can assume that those shares become exercised in a reasonable fashion, and we won't see a huge uptick in outstanding shares. So I'm going to assume that the 0.9% will persist here for the next couple of years. Profit margin, you see that historically it's been 18.8, and the forecasted profit margin is also 18.8. So Google's been around long enough that it seems reasonable that they've kind of settled in on a profit margin that will persist. The competitive advantage period default is 5 years. I'm going to leave it as 5 years. And then that leaves us with company PE. Currently it's right around 28, approaching 29, but the future PE is 14.2. Well, as discussed in other videos, the way you can quickly see what the implied cost of capital is in that PE ratio is just take 1 divided by the PE ratio, actually 1 minus the PE ratio. So I'm going to take 1 divided by 13.2, and that gives us about a 7.5% cost of capital, which is what you Polaris used. Now, as a reminder, we're assuming mean reversion as a default, and when you assume mean reversion, the PE ratio is, or multiple, is equal to 1 plus the cost of capital divided by the cost of capital. So do the math. You just take 1 minus the PE, or 1 divided by the PE minus 1, and it gives you what the cost of capital was used. And in this case, it's 7.5%. Well, compared to the calculated historical, based on historical relationship to the overall market of 7.7, to assume a future cost of capital of 7.5% seems reasonable. So really the only value that I think is worth considering changing is the sales growth. And if we just do some sensitivity analysis, again, I could take it all the way up to 50, which is what the CNN used, and we can see here that raises the practical investment return to 18.2. So I feel that that's a little too aggressive, but 26 is probably not aggressive enough. So if we just split the difference, you end up with something like, what the difference there is, 2012 or so. So you're up to about 38%, something like that, in this range if you just were to split the difference. I think that's a reasonable thing to do in this case with such a wide opinion, and really a lot of opportunity ahead of Google. That this, even though 36% sales growth year over year for 5 years is asking a lot of any company, but if any company can pull it off, it's probably Google. Well, if it pulls that off, you, as the investor, if you were to go in at today's price of 1,067, could be making 12.2% year over year for cost of capital, or what the risk rate of return of around 7.5%. Seems like a reasonable trade-off, and so concluding that Google at its current price is a prospect.